Good morning, everyone. We'll just wait as the numbers build. They're just scrolling through. So we'll get started in a minute. Okay, I think the numbers are still building, but I think in the interest of time, we're on 10:30, so we'll get started. So good morning, and thank you for joining us today for the investor presentation for the FY25 full-year results for EQT Holdings Limited. My name is Mick O'Brien. I'm the Managing Director of Equity Trustees, and I'm joined today by our CFO, Joanna Platt. We've got 45 minutes scheduled for this morning, and our agenda is that I'm going to provide a summary of the business's performance. I'll then hand over to Jo, and she'll take you through the financials in detail. I'll then close with an update on our strategy and the outlook, and then we'll open to questions at the end through the chat feature in this meeting. So the key points for FY25 have been strong financial performance, experiencing record growth in funds under management, administration and supervision, and strong top-line revenue growth. We've had a turnaround in expenses as we successfully closed out the three-year strategic projects agenda, as we flagged at the half year. We've successfully delivered on the project agenda by fully completing the integration of AET and delivering the new technology platforms, and finally exiting the discontinued corporate trustee services business segment in the UK and Ireland. Lastly, I'm pleased to say we realised more than the planned synergies relating to the AET acquisition. Now, this page shows the key highlights of the year. I'm pleased to say the results reflect an improvement in both the statutory and the underlying profit measures. The key financial metrics for FY25 are that we had a very strong uplift in net profit after tax due to the completion of the three-year strategic project spend and the continued growth of the business. Net profit after tax increased by 60% to 33.2 million. Funds under management, administration and supervision, or FUMAS as we call it, grew to 254 billion, up 28% on the prior year, driven by the growth in CSTS through a combination of new appointments and growth in size of the existing portfolio of schemes and superannuation funds. Revenue grew by 7% to 182.5 million. The underlying net profit before tax was 53.7 million, an increase of 4% on the prior year, primarily driven by CSTS's profit growth. Earnings per share grew by 60% to reach 124.26 cents per share, and the board's declared a second half dividend of 56 cents, bringing the total dividend for the year to 111 cents, an increase of 7% on the prior year. Finally, the total shareholder return to 30 June was 9.7%. So FY25 represents the end of a three-year journey for us to position Equity Trustees as Australia's leading trustee company. Let me go through our major objectives and the delivered outcomes. Trustee Wealth Services, following the acquisition of AET, has positioned itself as the leader in almost every state in Australia and each sector of trusteeship, strongly growing its health and personal injury book throughout the year. Our second objective was to drive growth in corporate trustee services. This business has great momentum. There's been 126 new schemes over the last 3 years, of which there were more than 50 new appointments in FY25. Portfolio of listed vehicles has continued to expand, with a portfolio of 27 active ETFs and listed investment trusts now in place, and more coming on as we speak. And we proudly took on the responsible entity roles for the largest IPO in Australia last calendar year, and also the largest IPO in Australia in this calendar year so far. We completed the protracted process of exiting the UK business, and it's now in the final stages of liquidation with no more expense to come. And finally, our investment in the modernisation of our core technology platforms has been successfully delivered. We have a new trustee platform for Trustee Wealth Services, called NAV1. We have Workday in place for human capital management, payroll and financial reporting. We've migrated our technology infrastructure to the cloud whilst upgrading our cyber security systems. Whilst technology investment will remain a key for the business going forward, the breadth of the agenda will be more focused, and it will be focused on CSTS in FY26. Now, this slide shows revenue and margins over each of the last 6 halves. You can see revenue growth in the last half has been 4%. Compound revenue growth over the last 3 years has been 15% per annum. Importantly, you can see the margin improvement. We now have a reversion of our statutory result to our underlying result as we forecast. The underlying EBITDA margin has increased from 26.6% to 34.4% in the half, and the statutory EBITDA margin from 31.3% to 35.2%. Going forward, you'll only see statutory results without any underlying measures. Now, we continue to track against our strategic T4 targets for client satisfaction, employee engagement, shareholder value, and our impact on the community. We've seen a slight decline in client satisfaction, although we still maintain healthier results with positive net promoter and net loyalty scores. The decline's been attributed to the significant client transitions we did to the new NAV1 platform throughout the year, and we expect those results to improve in FY26 with the settled platform. T2 employee engagement's held steady at 72%. Our shareholder value continues to grow, the statutory EPS up 60%, as I mentioned before. Our community impact is high again in FY25 with $170 million of charitable grants made throughout the course of the year. It's down on FY24 off the back of lower dividend income in the Australian equity market coming into our relevant trusts. Now, the impact on the business of regulatory developments continues to be significant. The team managed an extraordinary volume of regulatory change and other regulatory load throughout the course of the year. The most significant developments were the introduction of the financial accountability regime in March and the introduction of a significantly strengthened superannuation prudential standard CPS 230 starting at 30th of June relating to operational risk management. And there are a raft of other changes were implemented during the year and more in train currently. Now, I note there have been two well-documented issues that I'll comment on. The first relates to a native title trust for the Noongar community in Perth. Following the WA Ombudsman's tabling of a report in the Western Australian Parliament last week regarding the purchase of a property intended to address homelessness in the community, we released an ASX statement stating that we disagree with the finding of the WA Ombudsman and we consider we have fulfilled our responsibilities as trustee and will respond to that report in due course. We remain deeply committed to the purpose of that trust and the intent of that trust, as we always have. And we note that the Australian Charities and Not-for-Profits Commission, the ACNC, did not reach the same conclusions as the WA Ombudsman. The second relates to the Shield and First Guardian Master Funds. I want to start by acknowledging the deeply difficult circumstances for individuals that have been affected by these events relating to the Shield and First Guardian Master Funds. We're engaging with the regulators and the broader industry and are committed to collective industry action that further protects investors' interests. One of our two superannuation trustees had exposure to two of those schemes. The exposure was within two of our superannuation funds. The amount of funds invested in the two schemes under our superannuation trusteeship was less than a quarter of the reported $1.1 billion total investments in those two schemes. Importantly, Equity Trustees was not the responsible entity of either of those schemes and has no relationship with other parties involved: financial advisors, dealer groups, lead generators, responsible entities, fund managers, and property developers. Equity Trustees' governance program identified irregularities in some applications made by Venture Egg advisors in late 2023. We promptly ceased accepting applications from those advisors, and we reported Venture Egg to ASIC, as we're required to do under an AFSL, when believing another AFSL holder is potentially breaching its licence conditions. Equity Trustees is extremely disappointed that members' benefits are likely to be negatively impacted and will be taking every action possible to keep members informed, engage with the regulators, and achieve the best possible member outcomes. We do expect a distribution from the Shield Master Fund within the next 3 months. Equity Trustees is cooperating fully with any inquiries or investigations being undertaken by ASIC and APRA. Equity Trustees Superannuation Limited, the trustee entity, has received and responded to multiple notices from ASIC requesting information. ASIC has not alleged any breach of law by Equity Trustees Superannuation Limited. We continue to work collaboratively with all the stakeholders to deliver industry-wide improvements that support a robust and resilient financial services system. Now, let me move to Trustee Wealth Services results. So, Trustee Wealth Services has continued to grow revenue and FUMAS in FY25 at a steady pace. Revenue has doubled over the last 3 years, aided by the acquisition of AET, and importantly and pleasingly, the achievement of $7 million in synergies from that acquisition. You can also see on this slide that we're now showing the split of revenue between asset-based and non-asset-based fees. The growth rate of revenue in FY25 was just over 3%, and that reflects the exit of the AET platform business and also some one-offs in FY25, which Joe will walk you through later. The CSTS, the corporate side, has continued to go from strength to strength in FY25. We established 53 new schemes or took on other trustee appointments in FY25, including, as I said, the largest IPOs of last calendar year and so far this calendar year, showing we are the trusted partner in this market. The client growth in driving the year-on-year revenue growth is replicated with strong performance from FY25 continuing on across all the sub-segments of fund services, custody and debt and securitization services. The split of market-related and non-market-related revenue is really important for this business because it can distort the results. Typically, non-market-related fee arrangements are at a lower level, and often because they may involve directed type roles or the scale of funds is so significant. You can see the $33 billion in FUMAS growth that occurred, about half was attributable to market-related fee arrangements and half to non-market-related fee arrangements. And the pipeline remains really strong for the start of FY26. In the superannuation business, we're the leading independent superannuation trustee in the Australian market. The recent regulatory activity is driving higher compliance demands, and heightened risk is reinforcing our essential role in the financial ecosystem. During the year, we onboarded 4 new funds for $6.7 billion of FUMAS. We also had to merge 3 other funds, which resulted in reduced revenue. Nevertheless, overall revenue increased by 8% in superannuation during the year. We also manage operational risk financial reserves for some of the superannuation clients, and they flow through our balance sheet. This results in interest costs and offsetting interest revenue, which is effectively neutral to profit. The growth in those holdings in FY25 contributed about $1 million of the revenue growth of the year. Now, this table shows investment performance in alpha terms across the key portfolios. Our asset management team currently manage $6.4 billion of funds. You can see that recent performance in Australian equities, one of our global equity strategies, has been challenged, but generally we've got very positive alpha generation across each of these asset classes over most of these time periods. So now let me hand over to Joe to take you through the results in some detail.
Thank you, Mick, and good morning to everyone. And I'm pleased to present to you today the financial results for EQT for FY25. Firstly, to review the key lines of the P&L. As previously mentioned, revenue for FY25 was $182.5 million, up 7% or $12 million. CSTS revenue growth contributed $8.5 million of this increase, driven by $3 million of new business and net inflows into existing schemes, $3 million due to the impact of positive investment markets, and $1 million of incremental ORFA-related revenues, and a further $1 million of regulatory-related project revenue. TWS revenue increased by $3 million, the net impact of the benefit of AET synergies of $2 million, new business and net flows of $2 million, and the impact of positive investment markets of $4 million. This was, however, offset by the impact of the exit of the AET platform business at $1.5 million and non-recurring and lost business revenue of $2 million. Operating expenses increased by 8.3%. And whilst this was above the revenue growth rate, there were a number of transition issues that contributed to this outcome, which I will talk to further in an upcoming slide. Underlying net profit before tax was up 4.1% to $53.7 million, and margins softened slightly by 80 bps to 29.5%. Importantly, non-operating expenses declined by $6.6 million to $4.9 million in FY25 due to the wind down of the AET integration and technology deployment activity. The after-tax profit impact of the discontinued CTS EU business was $0.7 million, as the UK business was deregistered by the regulator in December and is now in the final stages of liquidation. Therefore, NPAT increased by just over 60% to reach $33.2 million, driven by the growth in underlying profit and the reduction in non-operating expenses and the progressive exit of the discontinued business. Given that FY25 was a story of two halves, it's useful to walk through the result on a half-over-half basis. In the second half of 25, revenues increased by $3.7 million, driven by CTS and the impact of new business and growth of FUMAS in existing schemes. Operating expenses declined by $1.5 million in the second half due to the $2.7 million reduction in people costs resulting from the restructure that occurred in the first half, offset by increased administrative and marketing costs of around $1.2 million, approximately half of which are one-off in nature. Net profit before tax margins improved by 4.5% to reach 31.6% in the second half, reflecting the reduced cost base of the unified operating model of 2WS. Non-operating expenses further declined by $3.5 million to $0.7 million in the second half, as I've mentioned before, relating to the closeout of the strategic project activity. Therefore, NPAT increased by nearly $8 million half over half, reflecting $5 million reduction in expenses and $3.7 million uplift in revenue. Turning to the reconciliation between underlying net profit before tax and NPAT, and as Mick mentioned, hopefully the last time we share this slide, the number and value of adjusting items reduced significantly in FY25. Non-operating expenses were $4.9 million, and the impact of the discontinued CTS EU business was a loss of $0.7 million on an after-tax basis. To note, the effective tax rate in FY25 was 30.4%, a reduction from 32% in FY24 due to the decline in EU losses and non-deductible project costs. This page sets out the movements in operating expenses from FY24 to 25. As previously noted, they increased by 8.3% or $9.8 million. There was a net increase in people costs of $2.9 million. It's the net effect of a $4.2 million increase relating to additional resources to support growth in CSTS, a $1.9 million impact due to our annual remuneration review, and a $3.4 million reduction in TWS staff costs due to the integration of AT. Technology operating costs increased by $2 million due to the impact of moving to a cloud-based data service and the annualised impact of licences for Workday, Salesforce and NavOne, and additional cybersecurity services. Finance costs increased by $1 million due to the increased value of the ORFA facility, which is recovered via revenue. Outsourcing costs increased by $2.9 million as the transition of custody and fund administration services to Hub24 was completed. Other expenses increased by $1 million, in part relating to the launch of our new website and the costs for our first digital active philanthropy campaign. Given that people-related costs make up, we're doing the second half. Focusing on the change in operating expenses half over half, this slide bridges from first half to second half. Operating expenses decreased by $1.5 million over this time, driven by a $2.7 million reduction in people costs relating to TWS. There were minor changes in technology, finance and legal costs, and mostly driven by elevated regulatory activity, and other expenses increased by $1.4 million, as I mentioned before, relating to marketing and digital marketing campaign costs. Given that people costs make up 2/3 of our expenses, we wanted to share a high-level view of our employee count across FY25. This graph shows the count of employees at June 24, December 24, and now at June 25 for TWS, CSTS, and corporate functions. As you can see, TWS employee count reduced by 53 over the first half of FY25, a decrease of 20% as a result of the change to a single operating environment supported by NavOne. The number of employees in CSTS increased by 13 to support the growth in our portfolio, whilst headcount in technology and risks reflected the reduction in technology activity and some open roles in risk, which have subsequently been filled. The vacancy rate at June 30, 2025 was 3.9%, a slight increase on our prior year measure of 2.6%. However, we consider this within normal range. Turning to segment performance, here's a short form P&L and waterfall of net profit before tax for TWS. Whilst reported revenue grew by $3.1 million or 3.1%, this was the net result of a $3.5 million reduction in prior year non-recurring revenue relating to the AET platform exit and one-off estate management and trustee fees. This was offset by $6.6 million of revenue growth relating to AET synergies, new business of $2.3 million, $4.6 million impact of investment market improvements, and an offset of lost business of 2.1. Operating expenses increased by 5.3% or $3.7 million. The main driver here was the impact of the HUB24 custody fees increases of $2.7 million and people costs reduced by 1.7, the net effect of the restructure that occurred, offset by annual REM reviews. Increased technology costs of $1.0 million were incurred in part due to NAV1 licenses and the flow on of the corporate expense increase related to technology that I referred to earlier. The impact of transitioning the business to a single operating model resulted in some carriage of duplicate costs in the first half, and this resulted in a decline in profit over prior year of $0.6 million and a slight compression of margins by 1.5%. Given the change in TWS business over FY25, it's important to explain the progression in profit and margins half over half, which I'll cover in this page. This waterfall bridges from second half net profit before tax in 24 through to second half 25 for TWS. Over this time, net profit before tax has increased by $1.4 million, driven by revenue on essentially a flat cost base. Profit margins increased to be 30.8% in the second half of 25, 3.9% higher than the first half. Turning to CSTS, strong revenue growth, as we've mentioned previously, of $8.5 million or 11.9%. $1.1 million of this growth related to the $15 million increase in the value of ORFA facilities, as we previously noted, and the balance was the result of $7 million of new business or additional funds into existing schemes, plus the additional $3 million market impact and $1 million of super regulatory project revenue. This was offset by $3 million decline due to either closed or lost scheme appointments. Expenses increased by 12.4% or $6.2 million. This was driven by people costs, as we've previously noted, additional headcount and employees deployed into this business. The increase in ORFA financing costs, as we previously noted, is offset by revenue and an allocation of the increased corporate technology costs into this business. Margins softened slightly by 40 bps to 30%, and FUMAS growth was around 30% for both sub-products. As Mick noted, the board declared a 56 per share dividend for the second half, bringing the total to the year for 111 cents, a 6.7% increase. The payout ratio on NPAT was 89% at the top end of the board-approved target range. And as you can see, there is a clear progression of increased dividends aligned with underlying and now statutory earnings growth over the last 4 years. Turning to share a summary of cash and cash flow. Total cash and cash equivalents increased by nearly $18 million in FY25. Operating cash flows of $40 million were broadly flat year over year. However, this included nearly $4 million of restructure payments relating to the integration of AET. Net cash relating to investing activities was $3 million due to reduced capital expenditure in FY25. Cash outflows relating to corporate movements increased by $21 million to total $40 million. This included a $5 million increase in dividend payments and a $5 million repayment of a $10 million facility drawn down in FY24, which was put in place to support the integration of AET. And finally, closing on balance sheet. Our balance sheet remains investment grade, with total equity increasing nearly $5 million to $404 million and gearing reducing to 10.4%. In explaining the balance sheet, it is important to note the accounting of the ORFA facilities, which are represented as an equal and offsetting asset, cash and liability loan. These increased by $15 million in FY25, and we project this will increase by a further $50 million in FY26. Pleasingly, trade receivables and accrued income reduced by nearly $4 million due to improvements in invoice processes and collections activity. As I mentioned previously, corporate borrowings reduced by $5 million due to a part repayment of a facility. and we will be conducting a capital review of our allocation in the first half of 26. Thank you, and I'll now hand back to Nick to close our presentation with an update on our strategy and FY26 outlook.
Fabulous. Thank you, Jo. As we continue our journey to be Australia's leading trustee business, it's timely to reflect upon the strengths of the business. Firstly, our model, the independent trustee model, is increasingly favoured by the market, and our market leadership has us well positioned to capitalise upon that trend. Secondly, the growth of the investment markets is set to continue. It's underpinned by the growth in the superannuation sector and also the growth of intergenerational wealth transfer, and we're well positioned to capture that in all of our business segments. Thirdly, the enduring income profile of our business is attractive. Trustee appointments are generally very long-term in nature, and revenue is positively correlated to market movements. EQT continues to have a strong balance sheet, as Jo mentioned, with low gearing. We have an experienced leadership team with a proven track record of M&A and integration success. After a period of being internally focused while the integration of AET's continued, we're now actively engaging in inorganic opportunities. Finally, our assets, our highly engaged and capable people, our culture, and now we have a refreshed technology stack, meaning we're well positioned to enhance our operational processes and deliver great service to our clients. So our strategic priorities in FY26 are to continue to leverage our market-leading positions in each business to capture ongoing growth, particularly in CTS, design and deploy digital solutions to enhance the client experience and safety and to automate activities, and leverage our expertise to meet high regulatory demands and actively engage in conversations to shape future regulation. Let me finish with the outlook for FY26. Firstly, we need to note that the economy continues to face geopolitical uncertainty, which we're exposed to most directly through movements in investment markets. Based upon our business plans and pipeline of new business, particularly in CTS, where we provide the responsible entity services for fund managers, we expect a really positive outlook for FY26. We expect more moderate levels of growth in trustee wealth services, and we expect the new technology solutions to boost efficiency and service levels for those clients. I'm pleased to confirm that going forward, our statutory profit performance will be the focus, and the statutory result is now reverted to the underlying result. Our operating expenses for technology are forecast to now run at a more normal level of $2 million in FY26, with the majority of projects being focused upon CTS and the rollout of enhanced workflow and data automation and monitoring tools in that business. We also want to acknowledge the risk landscape and expect the standards of the regulators to continue to increase, and we will continue to invest as appropriate to ensure we meet those standards and expectations, and we're well positioned to do this, and we think we can manage this at this stage while maintaining our margins. So that brings us to the end of the presentation. I'm now happy to take questions. They are in the chat function. So we've had some that have been provided to us, so I'm going to start with those first. So firstly, where do you think the blame lies in the Shield Master Trust failure? Does EQT need to alter any of its processes in response? Look, it's not for us to direct blame. We're confident the matter is being thoroughly investigated by the regulators, and they are making good inroads, and we are engaging with them productively, and that is our focus at the moment. The next question that came in was, and I'll read it verbatim, we lost money on the UK island on Google for years. Then we had the merger. Can management just focus on executing, please? Look, we're pleased that we've successfully completed the 3-year restructure program and we've exited the loss-making European business. And really pleased with realising significant synergy benefits from the AET acquisition. The uplift in net profit after tax for FY25 and increased dividend demonstrate the improvement in performance across because of these changes. Our future strategy is to continue the growth momentum in the business and execute upon the technology initiatives that enable this growth. I've got another question that came in earlier, which was, what was EQT's role in the Shield First Guardian matters? How was the company associated or exposed to the Shield Master Fund? Now, I think I covered that issue earlier in some detail, and at this stage, I'll add to that detail, other than we're assisting the regulators where we can and ensuring members are as informed and as supported as they can at this difficult time. So the next question is, Mick, Joe, great results. Can you provide some further detail on the Shield, First Guardian and Noongar Charitable Trust situations, recognising ASIC's investigations ongoing? Does EQT believe that they've done anything out of line with SIS Act and other requirements? Well, look, there is two key acts, the SIS Act and also the Corporations Act, and we believe we've abided by all the requirements of those two acts. Price increases on seat superannuation. Is there something you'll look at this year, given the increasing regulatory burden faced in prior years that you've had to absorb and manage? Look, we are continually looking at the pricing of our services, particularly in superannuation and in corporate trustee services. And we've made some changes and will continue to progressively make some changes to ensure that our margins are maintained in those businesses or improved if that can be possible. Joe, this one's for you. Yeah.
Regarding tax in FY26 and beyond, is the lower tax rate seen in the second half consistent with what we should be expecting going forward with EU now gone, or was it a one-off impact? To answer that, we expect to run the 30% to be our go-forward position. As we noted, there were impacts in prior years from the overseas entities and also just the quantum of restructure costs. Someone's also asked about the capital review. So our current regulatory capital requirement, we've talked about this before, is around $70 million. In capital review, we're obviously just taking the time after we enter a new 3 to 5 year strategic plan horizon around the best use of capital and our leverage position. So we'll provide a further update at the half year.
Take the one.
Yeah, expectations for headcount in FY26. Good question. So we obviously are seeing continued growth in CSTS, and we expect that we will be allocating resources to support that business to manage that growth effectively and also to manage the regulatory and change agenda. So we expect to see headcount increases in that business in particular.
The next question I'll take. Corporate superannuation trustee services achieved solid new responsible entity and custody appointments. Was there a higher than normal level of opportunities in FY25, or could FY26 see a similar level of activity? Good question. Of course, the other questions were good too. But look, the new business activity has continued in the early months of FY26. I think Equity Trustees has always been the leader in provision of responsible entity services in the market. But I think that position has just been strengthened in more recent times with particularly the roles we're taking on in listing schemes. That is a significant trend that is going on for fund managers to access a broader market. So I can't say that the activity will be exactly the same as FY25, but there hasn't been really any let up in the first couple of months, and we've got a solid pipeline that we're working on developing new schemes at the moment. Well, that brings us to the end of the questions. So we've got one more that's just come in. So I think I might hand the first one to you, Joe, if you're good with it.
Yes. We see, as we've mentioned before in our commentary around CSTS and TWS, the momentum, we've given some commentary there around where we see growth to continue to be above average in CSTS and TWS moderating as it's now fully onboarded and embedded the AET revenue line into its result.
Thank you. Next question is, has the company undertaken a review of the process undertaken prior to the purchase of the El Caballo property? If so, what did it find? What standard processes followed with regards to due diligence? So I can say our normal processes were followed, and we were effectively acting at the request of Swolsk. And we've looked at those processes multiple times over the course of the last 4 or 5 years, comfortable with the process that was undertaken. Next question is, how much of a risk does the compensation now being sought by the South West Aboriginal Land and Sea Council present for the company moving forward? Well, look, I understand the South West Aboriginal Land and Sea Council issued a media release last week. I can say they have not made that demand to Equity Trustees, to be clear. All right. I think we've got to the end of the roll of questions. So If there's no further questions, I just want to thank everyone for getting on the call this morning. We appreciate that. We're delighted with this set of results, and we're looking forward over the next week and a half or so coming out to see shareholders directly and walking through them in more detail. So thank you very much for your attendance, and thank you, Joe, for putting this together. Thank you.